Thank you. This is a very exciting event. I see a lot of old friends, and I think this should be an exciting day. And so let me sort of lay some of the groundwork that we need to discuss monetary reform. And if I have enough time at the end, I will also talk about monetary reform myself, although this is not itself about monetary reform, this paper. And of course, the usual disclaimer applies. These are my private opinions. As a researcher, they come, however, out of published IMF and Bank of England working papers. So we need to think here about the nature of the financial system, is what I want to say by way of introduction. What conceptual framework do we use to think about banking? The significance of this question is that if we want to think about reform, we need to first of all understand what we're trying to reform. And in the 1930s, people faced a similar situation. And the past reformers that I have read quite extensively reasoned at the level of this conceptual framework. They went back to basics and said, what is the nature of the beast? And then what do we do about it? I would argue that recent changes have exhibited far greater technical complexity, which is hardly surprising because our financial system is just technically more complex. But the constraints they imposed on banks ended up being weaker than in the 1930s. I don't think that's a controversial thing to say. And I would argue that the debate about the financial purpose and design of the financial system, in my opinion, has been shallower. There has been a little bit at the fringes, but in the 1930s, the kind of debate that we're going to have in this room today was had among the leading macroeconomists of that time. So I'm going to talk about this in the framework of models because that's my métier, but you should be, this is not just sort of a geek exercise because models are also what is in the head of policymakers and what guides their thinking. So this is, and I will try to present models in a way that's accessible and just about what are they really about, what do they say about banks. So the recent work that has been done in academia and also at central banks overwhelmingly uses intermediation of loanable funds models of banking. And in that model, banks are intermediaries between savers and borrowers. And as I will explain, these are savers and borrowers of physical resources. So how you think about banks is that literally the banks are collecting physical resources, wheat, steel, radios, and then intermediating them to somebody else. Right? And as such, and in that narrow sense, the models that we're using are non-financial. They are about physical resources. And banks are essentially intertemporal commodity traders, or as an academic colleague of mine has called them, warehouses. Right? This theory misrepresents how credit created is in the real world because you will not find those warehouses out there doing financial business. And the solution that we have proposed is to use financing through money creation models where banks are creators of ledger entry money and intermediaries between different spenders of this money. So what the banks are doing is they create the purchasing power whereby people can buy physical resources from each other, but the banks themselves don't have anything to do with those physical resources. Ledger entry money means that these are financial models and banks are creators and intermediaries of money. And this theory is consistent with the actual credit creation process, and it is also consistent with many publications by some of the leading central banks in the world, including not only the Bank of England with those two papers in the quarterly bulletin in 2014, but also the Bundesbank with a monthly report in 2017, and the Reserve Bank of Australia with a report in 2018. And the list goes on, and it's getting longer. So here is, in cartoon form, the kinds of models that we are comparing. At the top is the loanable funds model, where a saver deposits essentially goods, and I will argue again why it has to be goods, and then the bank takes the goods and gives them to somebody else, and that somebody else literally then has to engage in barter. At the bottom, we have the financing to money creation model, where the bank interacts only with one agent, who is both the borrower and the depositor, and he comes to the bank in order to get a money loan and a money deposit, and he and she will then take the money deposit to engage in exchange. Now, once again, ILF deposits, loanable funds deposits, are not financial transactions. I want to make that very, very clear for everybody in the room. For many, it is already clear, but maybe not for everyone. All financial transactions, more or less, are variants of check deposits. So if I take some of my financial balances from one bank to another, and you can think of this as a check deposit. I deposit it in another financial institution. So what happens when there's a check deposit? Let's say we have households A and B, and they bank with banks A and B writes a check to A. I could be A, I get a speaker fee or something like that. I'm not allowed to get speaker fees, but if I get a speaker fee, B pays me. I have a check that's drawn on bank B. I take it to my bank A. What happens? This check only has value because the deposit already exists. This is not a new deposit. Otherwise, the check would be worthless, right? So I take that check and I deposit it in bank A, right? And then bank A acquires a claim on bank B to collect the underlying funds. And when I do the consolidated balance sheet of this banking system, nothing has changed. One deposit has moved from one bank to another, some reserves have moved around, and that's it. There are no loanable funds here. And you can reduce any financial transaction to that kind of thing, to that kind of transaction, meaning that the loanable funds model talks about, or somebody deposits some new deposits in the bank, and the bank does something. Now I have shown you that cannot represent financial transactions. It's just impossible, right? So what does it represent? It represents resource accumulation. And so here we have loanable funds deposits are basically physical resource accumulation, looking at it from a different point of view, looking at it from the point of view of the budget constraints that we typically write down in those models, which is delta D, the change in deposits, is equal to income minus expenditure, which says, this is the budget constraint of the depositor. This says deposits can only increase if somebody either generates additional income, that's a physical activity, I'm working, I'm getting something for it, or if someone consumes less expenditure, that's a physical activity, I eat less or something, or drive less. This is all physical, right? And that's how deposits can increase. And for the borrower, it's just the flip side of that budget constraint and the simplest possible balance sheet of the bank that you can write down in change form as change in deposits is equal to change in loans, right? The problem is, as I already said, banks simply are not intertemporal commodity traders. They don't move these physical resources through the economy. And it matters that we model them this way, because then if you want to model it this way, what matters for deposit accumulation is the incentive of people to save, the incentive to work more or to consume less. And that incentive has virtually nothing to do with how bank balance sheets change. And you can actually see this in the data. I'll show you if we have time, that savings accumulation is far smoother than changes in deposits and changes in the balance sheet of the aggregate banking system. Where when I say deposits here, incidentally, I mean the entire liability side of the bank, excluding equity, which is important to emphasize. Now, FMC deposits, financing through money creation deposits, are financial transactions. There you write down a budget constraint that says, for a representative guy who deals with the bank, change in deposits minus the change in loans is equal to income of a representative agent minus the expenditure of a representative agent. And then we write down the budget constraint of the bank again in change form. Change in deposits is equal to change in loans. And therefore, from that, we can see that the only way I can create additional deposits is by getting additional loans. And if you plug that into the right-hand side, that into the first equation, it basically means income has to equal expenditure, which, of course, ex post always has to be true, right? The operative constraint in this world is the deposits that the banks create have to be greater than or equal to some notion of expenditure, because deposits are used in order to exchange stuff in the economy. They're the lifeblood or the motor oil of the economy, right? And that's why they're important, not because the bank takes some physical resources and hydraulically pumps them through the economy. Now, ledger additions of the bank involve no intermediation. When a customer comes to me, I'm a former banker, when a customer comes to me, I write down two equal ledger entries, an asset and a liability, my loan and the loan and the deposit. They're both in the name of the same agent, right? There is no intermediation. The loan is the right of the bank to receive future installments. The deposit is the obligation of the bank to deliver current funds. And the magic of banking is that banks, unlike any other financial institution, once they have this IOU, I need to deliver funds to you, that IOU itself is the funds. Okay? No other institution can do this. And this is because banks are backed up. You could say it's because of diversification, maybe a little bit, but it's mostly because of the backup of the monetary and regulatory apparatus that governments have put in place. Okay? Now, FMC banks, basically what it means is they create their own funding in the act of lending, and therefore here I have in bold, the first two bullets are sort of like debunking some of the notions that you find in the literature often, namely the loanable funds. There are no loanable funds. They do not exist. Okay? The funds exist in the mind of the banker, and when the banker has a good business proposition in front of him or her, he creates the funds that he or she needs on that occasion. If it's profitable and if it's consistent with regulations and everything else. Also, banks do not collect new funds from non-banks as an aggregate. Banks do not collect new funds from non-banks. They create new funds for non-banks. They do collect funds from non-banks, but they are existing funds. I already explained that to you earlier with the check deposit. Okay? And these financial funds add to the economy's financial funds, and the financial funds are important because they are spending power. That's what we have in our wallets, underlying our plastic cards, etc., etc. And that's how they're important for economic activity. Now, this leads to something very important, and all post-Keynesians would be very interested in this point. What is it that constrains spending in the real world? Typically, as economists, we would write down budget constraint, and we would say that expenditure has to be less than or equal to income. That's true ex post. How about ex ante? When I go and I decide I see a new Porsche that I want to buy, am I constrained by my income? Of course not, because I have good credit, right? Well, I hope so. And I can go to the bank and get additional spending power. And the point is that nobody else needs to transfer his or her spending power to me so that I can buy that Porsche. The bank creates new spending power. Okay? And that means the banks create an additional stock of spending power when I come into the bank and ask for it, and they think I'm safe, right? This whole process is completely independent of physical resources. Nobody needs to give me physical resources or any kind of, even financial resources in order for me to be able to do it. The bank needs to write up its balance sheet to do this. But of course, when I buy the Porsche, the company, let's say this all happens in Germany, the company in Germany can create additional employment. So this will generate additional income. Right? So it is macroeconomically important. And ex post expenditure has to equal income, of course. Right? These are things that you find all over Schumpeter, Keynes, and Kaldor, but people are not making that point anymore. I have a new paper with Xuan Wang from Oxford University where we're making this point very explicitly. It also is in this model. So key differences in the properties of such models now. In the ILF model, deposits come from a physical saving process. Saving is slow and continuous. As economists, we impose preferences on agents, and that are realistic, that people don't like their savings to jump around a lot because they don't like their consumption to jump around a lot and their labor supply to jump around a lot. And that means deposits themselves are slow moving. And that means bank balance sheets themselves are slow moving, right? Which they're not, anything but. In the FMC model, deposits are created on a computer as book entry, and this process can be instantaneous and discontinuous. The banker can wake up in the morning, and if he judges the customer risk to be appropriate, then he or she can write up the balance sheet by 10%. Right? I mean, probably wouldn't do it because it's not prudent, but he can technically. Right? So that means that lending booms or crashes can happen extremely fast. So now I'm going to talk to you about the concrete models. And so I'm going to present one ILF and one FMC model. And except for the difference between these models, these are standard boilerplate models that you find among central banks, monetary, new Keynesian models. Everything is identical. Preferences, technologies, endowments, steady states, every single parameter. The only difference is in this model difference. And And let me, in the interest of time, skip over this. Banks, we have bank assets. There's a costly state verification, similar to Bernanke, Gertler, Gilchrist, so that banks can make losses on their loans. And in the event of bankruptcy, they repossess their borrowers' assets. Bank liabilities, a transactions cost technology, Schmidt, Grohe, and Uribe, very common in the monetary literature. That's why I need money. And then bank equity is subject to Basel regulation and risks, similar to my work with Jeremy Bennis. And the key difference between the models, and we have already seen this in different form, is the budget constraint and nothing else. As I said, in every single other respect, these models are the same. In the loanable funds model, you have a saver households and a borrower entrepreneur, and they have these slow-moving things because everything depends on physical saving. In the FMC model, we have the change in deposits minus the change in loan is equal to income minus spending. And these are, therefore, variables that if I want additional deposits, I go to the bank, I get additional loans, they go up together, and not much has to happen to income and spending. Not much has to happen, therefore, to the real quantities, to physical savings. Physical saving has nothing to do with this, right? And this is also highly favored by the data. So briefly, how does a model like this behave? In this model, we have 16 quarters. On the horizontal axis, we have a shock whereby the banker wakes up in the morning and his customer, and they all suddenly find that they live in a much worse world than they had thought until yesterday. And then the solid line is a financing model, the one that I favor, and the dashed line is a loanable funds model, right? And so what happens? On the right-hand side, you have financial variables, more or less. On the left-hand side, you have real variables. Let's start on the right-hand side. So everything is riskier suddenly. The borrower has become riskier. The banker wakes up. When he is a loanable funds banker, what does he do? He jacks up the spread. So you see there on the top right, the retail lending spread. So in that model, spreads go up by 200 basis points. On bank loans, he or she cannot do much because not much is happening in deposits, because what's happening to deposits depends on people's physical saving. And that cannot change very much, right? The financing model banker wakes up, faces the same situation, and then says, look, we have lent too cheaply and too much. We have to jack up prices and cut quantities. And so he or she still increases spreads by about 50 basis points, a lot less. And there's a lot more action on the financing side, that 5% decrease in loans and deposits. Loans and deposits decrease together. If you can then increase them together, you can decrease them together too. Right? You call in loans. And because you have called in loans, the loan-to-value ratios of remaining loans are lower, therefore less risky, and therefore the spread does not need to increase by as much. That's the reason why the spread doesn't increase by as much. You also get, in the financing model, pro-cyclical leverage, which is very important. That's actually something that people have found in the data, at least when using book value leverage, and you don't get that in the loanable funds model. And then up there, very briefly, you see the real effects. The real effects are stronger, and the real effect in the financing model, and they come because of what I call increases in the effective prices of consumption and investment. What is that? That is sort of the old-fashioned shoe leather costs of buying stuff when there is less money. When you have less money circulating in the economy, then transactions cost tells me that every single unit that I want to buy becomes more expensive to buy because I have to scramble to get the money together, basically, right? And that increase in that price makes consumption as well as investment drop. And notice, a co-movement of consumption and investment is a prominent feature of the data, and it emerges very naturally here because they're both linked together by the availability of purchasing power in the economy. Okay? That's briefly a simulation. Stylized facts, there's a lot in the paper. I can just go through a very few of them. And that's basically sort of one point that we have seen in those impulse responses is very rapidly and fast-moving balance sheets. Bigger magnitudes, also bigger jumps on impact. As soon as you see the shock, the bank can go like that and change the quantity of its lending, right? So here we have on the horizontal axis the change in the log of assets of aggregate banking systems, right? This is aggregated over all banks in an economy. This is the Eurozone, US, Germany, and France. Change in the log of assets, so it's basically a percent change, right? Just multiplied by 100. And the red line is the change in, the red dots are the changes in the log of debt. and the blue ones are the changes in the log of equity. And this is quarterly data. Every dot represents a quarter, okay? So what we observe is that bank assets and bank debt move virtually one for one, and bank debt is basically what I call deposits in the way I think about banks. Deposits and assets move one for one. Equity and assets, there's a cloud. You can't see much relationship because there isn't, okay? And also, some of these balance sheet changes are extremely large. Here you see 2%, 3%, 4%, 5%, 6%. You know, similar to the impulse responses that I showed you in the most extreme cases. Now, here we see the green line in these plots for the same countries and regions is savings over GDP, national private savings, and the black line is the change in credit over GDP. Right? And the red line is changing credit to non-financial business over GDP. These are the time series. And what you can see, let's focus on the US, you see that saving is much, much smoother than bank balance sheets. Sometimes for decades, it's at a completely different level. In the crisis, it goes up, not down. Right? If you depend on savings to contract your balance sheet, saving would have to go down. It actually went up. It has absolutely nothing to do with what happened to the size of bank balance sheet. The black stuff is the changes in balance sheets. They're extremely large, extremely volatile, and at many times of a completely different magnitude for decades. So there's no relationship. And finally, changes in bank balance sheet versus valuation effects, because the literature has said, okay, maybe if it's not saving, maybe there's something else that the loanable funds model can use in order to generate balance sheet changes, which is sales of securities or purchases of securities or valuation effects on the portfolios of assets that the banks have. And so let's again focus on the United States. We have the black line is the same as in the previous plot. Relative to GDP, the change in the size of bank balance sheet. And the brown line there is how much of that is accounted for by either valuation effects or purchases and sales of securities, and essentially is nothing, right? A little bit more than nothing. So that effect is not something that you can reduce to say, okay, a modified loanable funds model may be still doing a good job. Okay, so conclusions, and then I want to have one or two more slides sort of pointing in the future. The key contribution of this paper on the theory is that ILF models are not a correct representation of real-world credit creation. FMC models aim to fix that. We have done a model comparison, and we found that financing models would indicate to you that banks are capable, or the banking system, the way it's set up together with its customers, is capable of explaining far larger and far faster changes in bank lending, also larger effects on the real economy, and something that I didn't talk about is credit rationing during downturns. And so what we see is that credit is not physical in our model, but it matters an enormous deal for physical outcomes, i.e. for output, etc. You see, because in our model, despite the fact that banks are only writing up book entries, and they're not themselves channeling physical resources through the banking system, the real effects on output, on physical outcomes, was actually bigger. That's something very important. And that is because what I explained in the connection of Schumpeter, Keynes, and Kaldor is that banks create our purchasing power, and they have enormous power to do so, and purchasing power is critical for economic activity, right? And then we looked at the stylized facts. We just looked at that. So now the significance for monetary reform, just very briefly. The FMC understanding of banks to a very significant extent motivated the monetary reformers of the 1930s and 40s, and it included a lot of the top thinkers, Fisher, Knight, Simons, Friedman. What were their reasons? Now, I wrote that paper in 2012 with Jaromir Benes, and I only briefly have time to talk about two reasons, right? One of them is credit cycles. This is because that flows sort of directly out of the analysis in the previous paper. So credit cycles. The money creation privilege of banks can be a major source of credit cycles. Right? I mean, it doesn't have to be. If banks behave very responsibly, etc., then it's actually a very useful machinery to have because they can endogenously respond to credit demand. If that's all they do, it's all for the best, right? But it can also become a major independent source of credit cycles. And because the credit decision can be funded 100% in-house, the banker does not have to say, oh, do I have enough deposits in the vault to lend them out? No, I create the deposits, right? And in addition, because these deposits serve as the medium of exchange of the economy, the government and the regulatory apparatus have a major interest in making sure that this liability of the banking system is safe, because it's basically the lifeblood of our economy. So they guarantee it by various explicit or implicit way, and that means that banks and their depositors need to pay less attention to risk than they otherwise would, which exacerbates the first point. Now, I'm talking about the Chicago Plan because that's what the monetary reformers of the 1930s and 40s were about. So these slides are sort of copied from when I normally talk about the Chicago Plan. This money creation privilege would be removed entirely. Under the central bank digital currency, what we're going to be talking about later, that's not the case, right? So that's an important difference. So their intermediary banks would first have to persuade investors to make a cash deposit. And this deposit is risky, and it wouldn't have a government guarantee. And so therefore, the investors will be more cautious, and the bank will be more cautious. And this makes credit-driven business cycles less likely. But of course, it doesn't rule them out completely. People always say that. That's an objection to my point here. Oh, but it doesn't rule... Yeah, it doesn't rule them out completely. Because if somebody makes a credit decision, he can make a mistake, or she. That's always the case. But at least you can have an environment where this mistake is less likely. Second is bank runs. In this world, money is completely safe because its value no longer depends on either the quantity of private debts or the performance of private debts. Because what's on the other side of the balance sheet is not private debts. Right? Is a run on the credit system possible? Yes, it is possible. That may well be, whether it's more or less likely, that's something we can talk about. But the payment system is insulated from that and will remain 100% safe. And that is the main thing that we're always worried about when the credit system goes down, is what happens to the payment system. And that would be insulated from it, and credit problems could then be dealt with separately from the payment system. Now, reasons 3, 4, 5, and 6 are found in my paper, and I don't have time. I just got the 0-minute sign, but I'm doing really well here because that's my last slide here.